Hey Slippers, it's Tim Knight, and I wanted to do a video. I think I do these videos when the market really swoons because I'm in such a great mood, but I'm going to do them even when the market doesn't do much of anything, like today. Today was, I saw a lot of comments about just how boring it was today. That's okay. You can't have excitement all the time. I guess especially in sharp contrast to yesterday's big rally. Here's the ES on an hour bar basis, and it's sort of an interesting graph. We see here back on February 18th the peak, and then we had this triangle form that I'm pointing out that we were all watching the triangle kind of bounce and get tighter and tighter within the range. It finally broke, retraced, and then fell hard, retraced and fell hard again. So very violent. This was about a 100 points on the ES, but it took a good month to transpire, half of which was just in the span of the whole Japan nuclear / tidal wave disasters. And it took only 3 days to really recapture about half of that loss. And it seems, hopefully, petered out as of yesterday. Get kind of a bit of a double top right here, as it were. 7 a.m. on the 21st and 1 a.m. this morning. I've drawn this line on the ES at 1296.50. Naturally, what I don't want to see is for it to cross that line. There's a lot of overhead supply in this area. I think that line isn't a bad one. And it would be really bad for the bears if we crossed above this prior high. In other words, if we get to 1304 or higher. Anyway, so that is that. Backing up to more of a daily chart here, we can see this very large wedge, which the triangle was the noodling around on that wedge and finally broke free of it and has retraced. And what I'm positioning myself for is a continuation of this drop to a somewhat lower level, maybe about 20 to 30 points beneath the lows of last week before I cover everything. So I'm about 70% committed on the short side. If we look at the SPX index, the S&P 500, see a much broader picture. Zooming in here, see the same wedge, the same resistance line, and this line right here at about 1227 on the S&P. That's my target. Anywhere it could fall anywhere within, I think, this range, 1200 plus or minus 20 points for the medium term. Looking at the VIX, the VIX had gone from 15 to over 30 and is way back down again in a very short amount of time. So we went from under 15 to over 31 in about a month, and it's gone from that level to almost got back into the teens today. Actually did for a moment get back into the teen zone on the VIX. So that spike really sticks out even on a very large graph. And if we look at the XAU, just to round up one index here, we can see the this trend line was broken back in January. And as strong as gold and especially how strong silver has been, this is still kind of a broken graph here. But silver strength is just something to behold. Changing pace a bit, looking at interest rates. My view is that interest rates are poised to drop. Although I am not long TLT, I am effectively long TLT by being short TBT. I'm sorry. I am short TBT. Anyway, this is the Treasury Bond Fund. If we go to like a 120-day hourly graph, you can see here very handsome basing formation, gapped up here, and sort of inching higher. So this is to me a very, very nice base from which this can launch into higher prices. Naturally, higher bond prices means lower interest rates. and I have shorted this instrument, TBT, which is the ultra short on the treasuries. So kind of a queer way to go about it, but it's basically banking on interest rates going lower. Now, as far as the dollar goes, the U.S. dollar cannot seem to get up off the mat. The euro, as I pointed out in my final post yesterday, is getting awfully close to this confluence right here of the Fibonacci fan, the prior high, and this descending trend line. And the euro actually managed to slip a skosh today, 0.13%. But anybody looking at the dollar can see that it just seems to be like a new lifetime low every single day. Closed essentially unchanged today, but it's just really been smacked badly. Wrapping up with a couple of ETFs here. Here's IWM. This is the Russell 2000. Interestingly enough, take note of this this prior high from back in 2007, which is where I've kind of anchored my Fibonacci. That's also pretty much exactly where this gap is. So I've drawn at 81.75. I've drawn a horizontal line there to show that gap's top. And if one were short this, I would use that as a stop loss level. Finally, retail RTH. This is in a pretty nice head and shoulders pattern. It's broken beneath the neckline. If we go from a daily chart to a more of an intraday view, not the Earth's cleanest neckline, but not bad either. 104.64. Any further weakness in the market, I think, could send this down into the just beneath the $100 zone in pretty short order. So that's it from me. The recovery, kind of the relief rally from Japan settling down and Libya kind of, well, not really settling down, but at least going decently well, lasted for 3 days. We'll see if today's very modest amount of weakness continues. I hope so. We'll see. All right, good night.